Now, Durgesh Kinarkar has sent in today's last question. He wants to know if it's a good strategy to do SIP in direct equity stocks. How is it different from an SIP in mutual funds?
Conceptually, it is the same, because you invest in why I suggest SIP in equity fund is the same reason why you should be investing in even shares in a staggered way, because we are not very sure. You can choose a good company, but you don't know if it is the best price. So spreading your investments over time reduces risk, reduces anxiety. Uh, but it is not the same as investing in mutual fund. Investing in mutual funds, you have one benefit and one disadvantage. One benefit is that it provides you the convenience and a professional management. You know that, okay, you are putting your 5,000 rupee, 2,000 rupees, small money, and it gets into a mutual fund, and you remain there. Whatever the fund manager does, you have, your tax, implication will be on your holding period. If you put your money and you take your money out 20 years from now, the gains will be applicable on the money invested and the money realized, and it has nothing to do with what the fund manager has done with your money, sold it 10 times during the year or whatever. He might be generating short-term gains, long-term gains. It is none of your business. As compared to that, investing in a share, you will have to keep an eye on it. You have to, you might do a SIP, but there is a need for selling, the stocks. You have to keep an eye on what has become very expensive, what is no longer a good stock, what has become more attractive today, what to buy, what to sell. So that requires, some degree of active involvement. So if you have the time, if you have the inclination, and if you have the temperament, because and if you can do these things well, and if you enjoy doing it, go for the shares. Go for your SIP in equities shares directly. Otherwise, entrust your money in a mutual fund. And also, for 2,000 rupees, 5,000 rupees, 10,000 rupees, it may not be worthwhile to be an active investor. So I would say that, there is a hierarchy based on your experience, which every investor should follow. One is that if you have never done any market linked investments and you are investing, I'm assuming that this hierarchy is meant for any long-term investor. Long-term investor meaning investing for 10 years and maybe investing for 20, 30, 40 years. Everybody should start with a balanced fund or a tax saving fund, because you get stuck for 3 years. So if you are a taxpayer, invest in a tax saving fund or a balanced fund. Do it for 1 or 2 years. So you will understand and you will reconcile with the volatility. Then comes, invest in an equity fund, 2, 3, and move all the money that you have accumulated in balanced fund or anything, and move that money into 2, 3, a diversified equity fund, aggressive fund, and continue your investment for another 2, 3 years. So after 5 years, if you think that you can reconcile with the ups and downs of the market, you enjoy reading the annual report of a company, you have enjoyed, you have understood how to choose a good stock, and you have the temperament of, investing in a stock even while it is going down because you have the belief, or you're able to spot an opportunity where you hold a stock and things are going wrong and you'll be able to sell it. These are the skills. These are the this is the understanding which an investor requires. So after 5 years of doing with your balanced fund and your equity fund, one should consider that. And also, don't do it at one go. Maybe, move your 20% money, 25% money into equity, all the accumulation in the equity fund into equities directly. Try it out for 1 year, then take it to 50%, then take it to 75%. So this will be a methodical way of learning equity investment firsthand with your own money. And then there will be advantage of this. The advantage will be that you will also, all the service that you get from a mutual fund, the convenience, professional management, and all that, you should be, you will be able to, you get it for the management fee. There will be 2 rewards. One, you will save on the management fee, and you will start enjoying investing in stocks, shares directly. So this is a 5-7 years plan. I don't think you should do it in a hurry, and don't get attracted to the market for making quick buck, because if you are able to, attracted to the market because easy money is being made, people lose money as easily there too. And one more thing, of late, a lot of investors are getting attracted to the stock market because it's going up. It's just refusing to go down. And more and more people, and investing in share has become frictionless. You can go to a Zerodha, Grow, Paytm Money and start investing tomorrow, and they don't charge you the transaction fee for your delivery transactions. But the charm is that they are basically looking forward to you becoming a speculator with the futures and options, the derivatives. Don't do that. It's a very risky thing. What the old man, the Warren Buffett, everybody quotes him that they are instrument of mass destruction. They are very risky. It is like having a leverage trade. So easy money is being made, and so is easy losses. A lot of people have not experienced that. Don't get attracted to it, or if at all you get attracted to it, try it out with a very small sum so that you understand the nuances of it, and you understand that it is not that easy. It is very complicated, and it is entirely dependent on your luck, or reasonably dependent on your luck than skill or understanding.